Okay, what's going on, everyone? This is going to be the first video for the problems for chapter 2. We're going to look at just the first two kind of sub items here. So we'll break it out into two videos. The first one, right, we're just essentially focusing on transaction analysis, right? You can think of this like the general journal, right? We will be doing transactions as they happen. And what we're really going to do is just the journal entries, right? So we have 1 through 8 little sentences. We'll go through, we'll do debit, credit, make sure our total debits equal our total credits. All of this should be a review, right? And just our little kind of cheat sheet down here to help us, right? We have our assets equal our liabilities plus our stockholders' equity, right? We said generally you're going to be plus minus. Over here, the reverse, minus plus. We always do debits on the left, credits on the right, debits on the left, credits on the right. And as a general rule, right, you're going to debit your expenses and credit your revenues, right? So that can be our kind of like cheat sheet down there for this. Let's look at these one at a time, right? So we have one here. It says we issued 30,000 shares of non-par common stock in exchange for $300,000 cash, right? So I don't know, let's just make our assets yellow and then our liabilities and stockholders equity, we'll just make our liabilities blue and our stockholders equity green, right? In this case, right, we have common stock in play, right? And we have cash in play, right? Afterwards, do we have more cash, less cash, right? So it's asset plus, we'll debit the cash. We now have more common stock that we issued, stockholders equity plus. Accordingly, right, we will do debit cash, we will do credit common stock for 300,000, right? Our total debits equal our total credits. Okay, next up, right? Let's look at the second one here. Purchased equipment for $40,000. Of that amount, right, 10 was paid in cash and the rest was on a note, right? So we have cash in play, we have equipment in play, both of which are assets, and then we have a note payable in play, right? So if we were to do the journal entry for 2, right, it will be debit equipment. Let me just make this a little bit bigger here. Uh, Credit note payable, credit cash, right? We know the equipment was $40,000, right? We know that we paid $10,000 in cash, right? They don't tell us explicitly what the note payable is, but we can back into it in the sense that our total debits of 40 have to equal our total credit. So that means that this has to be $30,000. Okay? Nothing too bad on that one. All right, let's look here, right? It looks like we bought inventory at a cost of $90,000. Right, so let me just kind of do this, right? It's inventory, but it's on account, right? Which is basically saying, hey, we tell the person we will pay them later. We use a perpetual inventory system. So what this is saying for 3, right, we'll do debit inventory, an asset that increased, and then we will have credit account payable, a liability that has increased, right? So in that way, right, it will be what, 90,000, 90,000. Nothing too hard on there. How about 4, right? We sold goods to customers on account for 120. The goods cost 70, right? So remember we said in the PowerPoint lecture, if you sell stuff, it requires 2 journal entries, right? So I'll do 4A and 4B, right? The first one is going to be to record essentially the sale based off what we sold it for. And the second one is going to be to record the cost of goods sold based on what that inventory cost us, right? So in this way, right, so we have goods. Let's just kind of highlight some stuff over here. We're making our assets yellow, right? we sold some stuff, so that's going to indirectly impact our stockholders' equity because sales are part of our retained earnings. We also have cost of goods sold, which is kind of a stockholders' equity account because expenses affect net income, which affect retained earnings. So to do this, right, the first thing we'll do is record the sale, right? They tell us it was on account, right? So they're, right there on account. So what that means is we will have debit accounts receivable, we will have credit revenue, right? And this will be based off what we sell it for, 120. We have the second journal entry based on what we paid, right, for the cost of goods sold, right? Debit cost of goods sold, an expense, credit inventory. This will be, let's see here, $70,000. Okay. So let me kind of make that a little bit wider. Nothing too bad for 4. How about 5? Right, we paid $5,000. Oh, 5. We paid $5,000 in rent on a warehouse, for the month of March. So what we essentially did here, right, is we just paid our rent, and it was for the month that we utilized the rent, right? So for 5, this is going to be debit rent expense, credit cash for 5,000. Okay, so you can see I'm just kind of building it out, trying to get quicker and quicker in doing these. So 6. Right, we paid $6,000 to an insurance company for an insurance policy for a 1-year period beginning April 1st, 2027. So we're in March, right, but we're buying a 1-year policy that starts in April. So we are prepaying our insurance here for 6. So this is going to be debit prepaid insurance, or a prepaid asset on there, credit cash for $6,000, right? 6. And that should be 5,000, not a big deal. Okay, nothing too hard. How about 7? Right, they're telling us we paid $70,000 on account for inventory purchased in 3, right? So up here, right, we bought some inventory on account. Now we're saying, hey, we pay off some of that account. So we got to flip out that payable, right? Debit account payable, credit cash. In this case, right, the amount they're telling us is what, $70,000. Okay. Last one here for 8, right? Collected $55,000 from customers on account, right? So we have debit cash, credit account receivable, 55,000, 55,000. Each of those, right? Our debits equal our credits in total. We analyzed, each transaction, did the journal entry. So all of this should be a review, right? The more you do these, the more you kind of get it. It makes sense. Let's move to exercise 2.8, right? The next one over here. So theoretically, right, if we looked at that last example, right, we did the general journal, right? We did all those transactions as they happened, A, B, C, D, right, 1 through 7. Now we're at the end of the period, right? We're going to have to do some adjusting journal entries to bring these accounts up to their proper balance. That is to say, to recognize any revenue we've earned, or alternatively, any expenses we've incurred. So they're saying, can you please prepare the adjusting entries at December 31st, right? Year 7, right? So we're at 12/31, year 7. Assume no financial statements were prepared during the year and no adjusting entries were recorded. Okay, so we essentially have 1, 2, 3, 4, 5 AJEs to make, right? 1, 2, 3, 4, 5. The first one, right, if we read it, right, it looks like a 3-year fire insurance policy was purchased on July 1st, 2027 for $12,000. The company at that time, right, so that little X, they debited prepaid insurance for the entire amount of payment, right? So we did this for one, right? It must have been right here about halfway through the year, right, on July 1st. So May, June, July, 7, 1, right? What that now means is, right, the remaining, right, rest of the year, 6 months have passed, right? 7, 8, 9, 10, 11, 12, right? 6 months have passed. The policy itself, right, they tell us here it was for 3 years. So that's 6 out of the 36 months for the policy, right? So it's based on the policy, not, it wouldn't be 6 over 12, right? It's 6 over 36, commensurate with that amount. So what do we do here? Let's first just think about the journal entry, the debits and the credits, and then we'll do the math, right? So we're accruing some insurance expense here, right? This is essentially going to be a deferred expense in the sense that we had the cash outlay first for the policy. Now we're going to have the recognition, right? So it's going to be debit insurance expense, credit prepaid insurance. That's great. But for the amounts, right, we're going to have to kind of do a little bit of math here, right? So they tell us that it cost $12,000, right? But we need to multiply that by the extent we've used this, right? 6 divided by 36. I'm going to pause that for a second if you want to write that down or enter it yourself, right? Accordingly, we should have $2,000 of insurance expense, okay, for one, right? So we're accruing the expense there. All right, how about 2? Depreciation on equipment totaled $15,000 for the year, right? So maybe we bought some equipment here. Now we need to accrue the depreciation expense. Again, it's a deferred expense. Nothing too hard here, right? Debit depreciation expense, right? We're going to credit accumulated depreciation, and they give us the math, right? 15,000. Pretty simple there, okay? How about 3? Right, employee's salary is of $18,000 for the month of December, will be paid in early January 2028, right? So we've had some employees work during the period, right? We need to accrue the expense, right? So we'll have expense first, but we'll only pay them next period, right? So this is going to be an accrued expense. What we'll do for this, right? We'll just do debit salary expense, right? Credit salary payable, and they give us the amount, right? $18,000. Okay, nothing too bad on that one. Okay, how about 4? Right, it looks like on November 1st, the company borrowed $200,000 from the bank. The note requires principal and interest at 12% to be paid on April 30th, 2028. Okay, so let's map this out, right? So, you know, it's a little bit messy over there, so we'll kind of keep it clean, right? Here we are, that's the end of the year. On November 1st, right, so we'll just put here 11/1, right? We borrowed some money, right? We're gonna have to pay it back over here, right, on 4/30 of the next year. But what we now have to do is, right, we have to accrue the interest expense for that, right, for the period on there. So this is going to be essentially an accrued expense, right, because we will have the expense first, but we'll only pay it over here, right? So what we'll do, just a little bit of math, right, we will first work on the journal entry, debit interest expense, credit interest payable. Just a little bit of math, right? So it'll be 200,000 times the 12% times 2 over 12 months that have passed, right? November and December. on there. That's going to give us $4,000. And then we can just copy that right over. Okay. Next up, last one, 5. On December 1st, the company received $3,000 in cash from another company that is renting office space in its building, right? So we must have gotten some prepaid rent. That rent was for December, January, and February, and we had unearned rent revenue at the time. So they gave us 3 months of rent in advance, right? For December, January, February. We're now at the end of the year, right? We have to accrue 1 month of rent that we have earned. So it will be debit deferred rent revenue or unearned revenue, and we can credit rent revenue for $1,000, right? 1/3, because they gave us $3,000 for 3 months. It's got to be $1,000 a month on there. Okay, so that's it for these problems. We'll stop it here.